All right, everything should be looking good. Any luck, we are live. Hey, what's going on, man? Coming through loud and clear. Let me know in the chat if you don't mind. And we will go ahead and get this stream started. Whew, all right. Welcome back to the channel, Crypto Trend Trader, with our Friday, well, not quite morning anymore, but market wrap up. Before we get started, I'd like to remind you it's not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. Hey, appreciate you, brother. All right, so sorry for the delay today. Unexpected event, but we're here now, so hopefully there will be no more unexpected events, and we can have that TGIF Friday stream. Obviously, seeing a little bit of bullishness in these markets, so let's get rolling. Hey, what's going on, guys? Good to see you. Appreciate you. Yeah, sorry for the delay. So what's up, Lazy Boy? Ricky Goldisberg, good to see you. Loud and clear, thank you. Milligan, hey, what's up, brother? UniQ, love a Friday stream. All right, sweet. Appreciate you guys. Yeah, sorry for the delay there. Had a little unexpected event, a little excitement, little morning excitement. But we're here now, ready to roll. So hopefully everyone else is as well. And sorry for any inconvenience this may have caused anyone. But nothing serious. Everything's fine now. So, all right, let's do this. Okay, let's run down the line. I'm gonna keep it try to keep it in line. We went a little long on the Wednesday stream, but we did go in depth on some important topics, including obviously the Fed funds rate and the Fed meeting. Since then, we have seen some pretty strong bullishness. I want to say nothing unexpected. I was not anticipating the market to be quite as bullish as it is, but to tell you the truth, I would say, stocks are pretty much in line with what I was expecting, and we'll talk about those targets and how everything's moving. Crypto as well, still kind of moving in between that monthly 8 and 21 moving average, like we discussed. Starting to see some bullishness from Bitcoin. Now, obviously, this is the third in a series of potential lower highs. But if we zoom down to the 4-hour, we can see on the futures chart and then also now on the spot market chart, we are very close to confirming a 4-hour, bull market once again based on 200 moving averages, etc. Now, we did that twice already and it got rejected. So I don't want to get overly excited, but we are starting to break through some descending resistance, etc. The one thing that has really surprised me, and it shouldn't, because it's been taking so much damage lately, but is China. And to tell you the truth, I really haven't been looking at China as something I was looking to invest in anytime in the near future. And then with the most recent Rona scare going on over there and the lockdowns and everything, I really wasn't looking at it either. What I was looking at was the capitulation in Diddy a few days ago. We saw a pretty serious dump. And now when I took a look at the balance sheet on Diddy and the financials and everything, it was actually trading at like a massive discount, based on value, like compared to its actual book value, like price compared to book value based on market cap, but also based on like its actual sales and market cap. Unfortunately, like an idiot, I skipped over it, didn't think twice about it, didn't see any immediate priority to take a look. And of course, now it's up like 50% today. We see Alibaba, Tencent, a couple other of the big Chinese tech stock names up very big in the last few days. So obviously, in hindsight, we would have preferred to have entered these positions, obviously. I mean, there's no surprise there. Anytime something moves 50% and you were looking at it and then didn't pull the trigger, you're going to feel like that. But that brings up a very important point. FOMO works for sure. I mean, everybody feels FOMO. Now, because I am, conditioned to not react to it in the same way, of course I will have like, that feeling of regret, like, damn, I should have pulled the trigger. oh, I wish I would have, brought that up on the last stream. I wish I would have did this, wish I would have did that. And you're always going to have that. You're always going to have some issues. Nobody's perfect. You're going to always miss opportunity. But I think the most important thing, and this is excellent because it brings up a great point, is that no matter how many opportunities you miss, or when you make a mistake or don't do something or whatever, rather than having regret, one of two things. You either learn from it or you understand that regardless of missing an opportunity, there's always going to be another opportunity. So it's not like now because these things ran up, we'll just never be able to invest in China again and we'll never have an opportunity again. And that's the end of it. And it'll be like that for many things. There's always going to be like, bear market rallies or short squeezes or aggressive moves based on technicals or fundamentals or whatever. And the most important thing is to not look at it as a missed opportunity, but look at it based on the technicals, look at it based on the charts, based on fundamentals, based on whatever it is that you're determining, and then just go from there. We have new data now. The new data is suddenly all these Chinese stocks are worth 50% more. So now we need to reevaluate based on technicals, based on fundamentals. Does that change the picture for us? Does suddenly the Chinese stocks, many of them being worth 50% more price-wise in the last couple of days, does it change the technicals? Do all of a sudden the charts look good? Does it change the fundamentals? Does all of a sudden China look like a good investment? Or is the price just different? Because honestly, that's the most important thing is to look at it like that, rather than just ignoring them, rather than not looking at them, rather than looking the other way or being, salty or mad or upset or disappointed or whatever. We have to look at it and then make a educated decision based on the technicals, based on the fundamentals, based on whatever it is that we were looking at them to begin with. And then from there, we can make an educated decision without feeling like we have missed out, without feeling regret, without feeling, remorse, whatever that mental state that it puts us in when we see a 50% move in something that we're potentially looking to enter and don't pull the trigger on. So now we can look back at it and say, okay, now this thing is fairly valued. It was clearly undervalued. Like, for instance, Diddy, where it was trading at 50% discount to book value, and now it's fair value. So how does that change the picture for us? And you know what? I should have just brought up the chart for it so we could kind of discuss this. Obviously, I wish we would have discussed it live on stream in advance, because it always looks so much better when we talk about something and then the market, shows us, and then we can look back and say, why were we thinking this? Why did this look like an opportunity, etc. But I mean, realistically, a lot of these things were just absolutely beat down and have been for some time now. But again, we need to see, does that change the actual technicals? Does that change, our outlook on the company in general? Like when I was looking at Diddy, was I looking at it, because I like the investment, because I like China, because, it looked like an amazing opportunity? Or was I looking at it because of the discount to book value? So if we just pull up our stats right here and take a look at it, we can basically see if we look at total revenue right here, we can see the total revenue was $20 billion. And then if we look at total assets, is at $22 billion. Liabilities, $34 billion. Why do these numbers not line up the same? Huh. Let me pull up my other one really quick. Hang on one second. I do not know what is going on with this data because it is completely different. I don't know if this is just an error on TradingView or what is going on here. But it's saying total liabilities are 34 billion and total assets are 22 billion, which is 151%. But I have total assets at 22.5 billion, which is the same, but I have total liabilities at 4.6 billion, which is obviously a massive difference. And then the market cap is at 18.8 billion right now, which if we take 22 billion and subtract 4 billion, we get 18 billion, and it's up 50%. So when I looked at this just the other day, it was trading at a 50% discount price to book. So I don't know what is going on here. See, this TradingView data might not be. Hmm. Yeah, I don't know. I'll have to look further into that because I mean, it's not like it's just a little. It's not like it's a small little, rounding error. We're talking about the difference between, $20 billion. Interesting. And this is, again, this could be an issue with TradingView. It could be an issue with the other information. It could have something to do with, China. But interesting. So yeah, I'll have to look further into that. But the truth is when I was looking at this, it was right around $1.80, and obviously it had a massive capitulation move. And it was, based on the information I had at hand, which, in hindsight, if I ever saw a discrepancy like that between two data sources, I would look into it further, but I would also be skeptical that there is that massive of a difference also. So, that's a perfect example of where something might have looked good and then actually the data was incorrect. Because if I would have seen this data here on TradingView, it wouldn't have looked nearly as appealing to me. But obviously, the alternative source made it look like it was trading at a massive discount, 50% discount, meaning that it was, severely undervalued compared to the assets on its books, which, is what we're always looking for, is a good investment based on, essentially if somebody had came in and bought the business and then liquidated it, even with, a discount for, you don't want to trade 100% price to book, because there's always going to be some kind of margin of error. But even if somebody came in and bought it and liquidated it, if it's trading at a 50% discount, or bought it and then just absorbed it into their company, you would assume that you're basically getting a good deal. You're getting essentially a 50% discount. So even with a margin of error, what would it work out to? 30%, 25%, anything. Getting a good deal. So that is interesting. I'll have to look into that further. But anyway, the most important thing is the psychology of it. So we'll go through those Chinese stocks and we'll look at them and we'll see, does now the psychology look different? Does the chart look different? Does it change how we look at these things? Or is this just one of those face ripper bear market rallies? And we'll look at that for everything, for stocks, for crypto, for all that. So let's go ahead and jump right in. No, it's not that the numbers changed when the price went up, man, because quarterly versus year. No, it's literally just the asset to book value. See, I have the see what I was looking at is total revenue of 21 billion, and the market cap was showing up as basically like 10 billion. Which obviously, if you have revenue of 20 billion and your market cap is like 10 billion, that's half what your annual revenue is. So even if you're not making money, the fact that you're bringing in that much money, you know, tells you that unless you have ridiculous expenses, that the likelihood is that if you keep generating that amount of income in the near future, you're probably going to be profitable. You know, if you have that much, you don't often see an unprofitable company valued that low, trading at a 50% discount of, you know, income to, you know, basically like market cap or price. And then on top of that, when you look at debt to asset ratio, you know, which is basically like your, you know, you can calculate your book value based on what the actual stock is trading at market cap wise, and then compare it to what your total assets are. So if you have total assets of, and again, what the numbers I was looking at was 22 billion, and then total liabilities were showing up as less than 5 billion, you're basically trading at 18 billion valuation based on, you know, your book value. And then the actual stock was, the total market cap was 9 billion. So it was showing up the market cap as 50% of total revenue annually and 50% of book value. So it's basically trading at a 50% discount. So when it jumps up 100% like that, now it's trading at basically fair value, which obviously if you look at, you know, the future value of like, you know, discounted cash flow, you know, most of the time things are going to trade at a multiple of that, not a discount. So something might be trading at 5 times sales or 5 times earnings or something like that. They don't often trade at 50% of sales or income or, you know, et cetera, et cetera. So that to me was a big, you know, a big yellow flag, like, hey, what's going on over here? But regardless, we'll take a look at that. Let me look into it a little bit further and figure out which set of data is incorrect here. But regardless, the most important thing is the psychology of it. And then we can look at everything and kind of take a look and see where does that change anything for China? Matter of fact, we can go over there and just start there today. I feel like we always go in the same way, so jump around a little bit and take a look. So let's start with Alibaba. So this is Alibaba. Obviously, we came down here, overshot the 786 slightly, and then we had a pretty aggressive bounce since then. We got the retest of the 618, which is what we were discussing last stream. Now, granted, we left a pretty large gap back here. We had a nice pop up, a consolidation, and now we have pushed all the way back up to retest the 618. So when we look at this on the daily now, does this change our outlook on Alibaba? When we look at this chart, does Alibaba look good or does Alibaba look bad? Well, when I look at this, to me, Alibaba still looks bad. I mean, this looks like a pretty aggressive rally, obviously, from 76 to, you know, 109 is basically, you know, almost a 50% rally if you bought the absolute bottom, and we're at now, yeah, 50%. So obviously that's a nice move. Who wouldn't want to participate in a 50% move in a couple of days? I mean, in hindsight, that's obviously, you know, one of the best trades you could possibly have, right? Well, we talked about this a little bit last stream as well, though. 50% up, all that did was just take us back to 65% down. So a 50% move to the upside looks good, but we're still down 65%. And then when we look at the actual technicals, what do we see here? Well, we see we're very clearly in a bear market, accelerating to the downside. The trend is strengthening to the downside. Now, obviously, we're in the bearish control zone. Obviously, we had a bunch of red histograms. Everything was pointing bearish. You know, we hit a nice fib and had a bounce off of it. But when I look at this on longer time frames, could this be the bottom? Sure, it definitely could. I mean, that might be the bottom. That's typically how things bottom, is either, you know, slowly and surely when no one's looking, or quite aggressively and, you know, all at once, never give you a chance to get back in at those levels. So it's definitely possible, but we're still very much in a bear market based on the weekly. And all we've really done is we just got so far away from the 8 moving average that now we're just retesting the 8 weekly moving average. I mean, before we would even be bullish on this on a weekly time frame, we would have to be back above 125 and then consolidating in order for the 8 to cross a 21. And even then, the target would be 180, and then we would assume further downside potential and take profits on a push up, because all it would be is essentially the reversion to the mean on the weekly. And then when we look at the monthly, you know, again, that definitely looks like a bottoming candle off of, you know, some key support down in this area. This is basically where a lot of price action took place back in 2015, 2016. But again, we still have the 821 cross to the downside. So, we're essentially catching a falling knife on any time frame based on all this China stocks. And then when I think about, okay, well, what has changed? What are the factors that we know has changed? And are they headwinds or tailwinds? Well, we know that, China is in bed with Russia. We know that for whatever reason, whether it was coordinated or not, that Russia chose not to invade Ukraine until after the Olympics, which were taking place in China. We know that Putin and Xi are, in talks. And I mean, undoubtedly, I don't think it was a coincidence. I mean, I even said ahead of time, I don't expect them to invade, but I definitely don't expect them to invade during the Olympics. And that played out perfectly because right afterwards is when it took out. Now when I say it played out perfectly, I'm not trying to float my own boat. Obviously, it's a terrible situation, but it was very predictable. I wasn't expecting it, but it was still very predictable. That was, that's how it played out. So we know that China and Russia are in bed together. We know China is purchasing Russian oil. We know that Russia is basically shunned by the entire world right now. We know China is on the verge of that. So I would say there's quite a bit of headwinds in China, and we don't see anything changing. Now, Biden's supposed to meet with Xi, and maybe that will change things, and who knows? But overall, I don't see it changing. And then on top of that, we know that, China is now going back into lockdown. Supposedly they're not going to be as strict. All these other headwinds. And then what is the main tailwind? I mean, what is the positive news from China? Well, they've come out and said that they're not going to be as unfriendly, or they're going to try to be friendly towards these, Chinese tech companies, and, make sure that the world feels comfortable investing in them, and this, that, and the other. They're going to let, essentially, potentially let outside businesses, organizations, regulatory industries, come in, regulatory agencies come in and audit them, et cetera, et cetera. So they're talking a lot of sweet talk. They're saying a lot of good stuff. And that's no doubt what's fueling this positive bullish move. And then obviously oversold metrics. But do I feel like this is going to change the overall outlook of what's going on here? Is this going to be what carves out the bottom? It's possible. It's definitely possible. It is. But based on the technicals right now, I really just don't see it. There's nothing right now that tells me that it's over, it's done, we're not going any lower, etc. So when the 821 crosses right here, green, assuming we hold above 102 on BABA, then, the next target to the upside will be obviously chew through this resistance right here, and then eventually retest the 200 exponential and simple. So by then the price will be at 150 because it was so aggressively moving to the downside. But at that point in time, we'll be back potentially at above the 200 exponential and simple, and then the technicals can look much better. So while the technicals will look much better, I'll be much more interested in trading with the trend, investing in the trend, as it would potentially be rolling back over and going to the upside. We'll have missed some opportunity for sure, but the difference is there's many opportunities along the way that happened already when it would have looked like the bottom. Now, obviously, this could have looked like the bottom right here. People would have FOMO'd into that. This could have looked like the bottom right here. People could have easily, FOMO'd into that. I mean, many people did. 30+% move to the upside. This would have looked like, a double bottom situation right here. 26%. The same way that this one would. But the difference between getting caught in these every time there's a sell-off is the risk to reward ratio. So you can find the risk reward ratio for a nice little trade, for a scalp, for the 821 cross and a potential move back to the 200s. But the actual risk to reward ratio is so much more important because of the probability of success. When you're in a bear market, the probability of success taking a long or an investment is under 50% because the trend is down. So while I do look at this as a missed opportunity for a scalp, or, a potential move to the upside, as some of these things were, completely oversold in potential, like, quote unquote, Cathie Wood deep value territory, we're still very far from confirming back into a bull market. And, while the risk reward looks better based on some of these statistics, it's still not probability of success over 50%, which is what we're looking for. So hopefully that makes sense. Now, obviously, you don't want to see, big moves in something you were paying attention to and then miss them and then FOMO in after the move. Much rather wait for the actual technicals. But if we look at something like Baidu, look how much closer this is to confirming back into a potential bull market. If we turn off the drawing tools, this is a retest of the 200 exponential and simple. Last time it moved up to it, it fell, retested, fell again, and we saw a capitulation down to 100. Now it's at 158. So again, nice move back to the upside. Still below 200 exponential and simple, but much closer to potentially confirming above them and getting that move to the upside. Hit our target to the downside. So we would not have been crazy, to take an entry back here based off of it hitting the 786, which was our target. But honestly, at the time, obviously looked terrible as well. So, we'll see in time. This one will obviously confirm back into a potential bull market on a shorter time frame, much before Alibaba will. And then if we look again at Baidu, on the weekly, this is obviously a very, very aggressive candle. What is this because of? Well, is it because of China talk or is it because of China action? Because when China basically comes in and says, hey, we're going to start openly buying stocks in the market, see, that to me is another headwind. It may seem like a tailwind because it's like, oh, we got the government on our side right now. But also, that's, blatant manipulation of stock price. And then they're going to open up their doors to regulation. That doesn't look good to me because anybody if they can do this to the upside, they can do this to the downside if they want to. And I'm not saying they would want to, but, we know they can't. So this is retesting the 200 exponential and simple on the weekly. If we start closing back above 166, technically this is going to look good again because it would potentially roll back over the 200 exponential and simple. And then again on the monthly, we're back here retesting 8 and 21. So this one looks much more bullish on pretty much every time frame. And then again, we see the same thing with NEO, very much in a bear market, had a nice aggressive bounce off of a key fib level. This was the 382 from all the way back here at the bottom. Obviously the target was a 0.5 for much higher prices. Bouncing the 382 would probably take us back up to retest the 236. We're still a ways off of the 200 exponential and simple and even confirming the 821 to the upside. So again, this is in many ways catching a falling knife for sure. We didn't make it down to technical support level, with the exception of maybe this little wick right here. But we are retesting the 8. So again, if we start closing back above the 8, start flattening this out, potentially move back up to 21, this starts looking much less risky once it's back above the 21 moving average on the weekly. Even though now the risk reward might be worse because it just had an aggressive move to the upside. So it's harder to put a stop loss in for a temporary trade. It's easier to put in an actual investment or trade for like a swing trade versus a scalp because it's confirming back into a potential bull trend on like a daily, a weekly, a monthly, etc. The monthly 8 and 21 have just crossed to the downside. So again, it wouldn't be unrealistic to think that we get a push all the way back up to 30. And then what happens at 30? Do we get rejected and it rolls over? And then you're going to look like an idiot if you got trapped in this position because you FOMO'd in. But you look like a genius if you scalped it and then sold that level. So, realistically, this is a downtrend. A scalp would have looked really nice right here, selling into resistance on, a face ripper bear market rally. But if we close back above 30 and start to cross this back to the upside, then it looks like a legitimate potential investing opportunity. So looking at the technicals on all three of these so far, Baba, Baidu, NEO, and now Didi as well, none of the technicals actually look any better than they did before. They look slightly better because we had a nice move. We had a big move up here. We basically, bullishly engulfed almost exactly that candle. But does this look strange to anyone? Sure, maybe this is a pincer bottom right here. basically two equally sized candles with a little wick. Maybe that's a pincer bottom. Maybe that's a complete coincidence that we have the exact volume, or size candle sell off and then the exact candle buy back off. Maybe that's a complete coincidence. Or maybe that is an extremely large player or potentially government pushing back up the stock price so that they can exit at a favorable level before continuation. Now, I don't know which one it's going to be. No one does. But on the weekly, we have a hard buy signal leaving the bearish control zone, and we're back at the level we were right before that capitulation candle. But the chart still looks bearish. We're still very much bearish on the weekly. And then on the monthly, we don't actually have enough data on this. This obviously looks like a nail, a potential bottoming candle. So in time, we'll see, was this a missed opportunity, or, was it market manipulation? Was it, a big player trying to exit their position and, they just have bigger positions than we do. So, you can call anybody that's a bigger play than you, manipulation if the move's against what you're looking for. Because I'll tell you right now, if we bought down here at $1.80 like we were looking at, if we would have done on stream last time, instead of spending, an hour or whatever on the Federal Reserve, I would have remembered to look at Diddy or whatever, and we would have took a even small position down here for a potential scalp. We would look like a damn genius, and we wouldn't be saying, oh, this is market manipulation because it's in our favor. I mean, I would, but most people would not be like, oh, they would say, I'm a goddamn genius. I knew it. I told you so. So the difference is kind of perspective in many ways. But for me right now, this literally just looks like everything we see in all these China stocks right now, and not all the Chinese markets are looking like this. It's mostly these Chinese tech stocks. It doesn't actually look any better technically to me. And the headwinds still look worse. The tailwinds are slightly better because China's at least saying, they don't hate these stocks anymore. If we zoom back out and look at the CN50, does this look good? Yeah, sure it does. We broke down from a key level, from support, and now we're attempting to come back up and retest that level that we broke down from. But again, when we look at the overall market, when we look at overall, China or an index of China or, whatever, with a, just a 100% unbiased look at it, we're still very much in a bear market, below the 200 exponential and simple. We haven't even begun to cross on the daily, the 8 and 21 back to the upside. So it's very difficult to look at this and be bullish on it, especially after a sudden 30%, 50% or more move to the upside. So this invariant, we even discussed, I believe on the last stream, this move right here was a potential retest back to the 200 exponential and simple, the reversion to the mean, to try to avert, the weekly bear market. So this looks very much like it. So again, if we close back above 14,533, this will look much more bullish than it does now. And we talked about this the last couple times, the 8 and 21 cross to the downside on the monthly, it actually would have been a pretty good buying opportunity. Now, we don't know that. We don't know if it's going to come back up here and cross the upside. But it's important to look at it. And regardless of if China comes out and says all of a sudden they're going to be favorable, they want people to invest, they're going to go ahead and let people audit, they're going to, be friends with the world again, et cetera, et cetera. We're going to meet with slow Joe Biden. Whatever the situation is, we need to still look at it through the same lens as we did before. We can't just all of a sudden throw technicals out the window or throw, a heavier weight on fundamentals, or just say, well, yeah, but they're saying good stuff. They're doing nice things. They're talking their book. So anyway, that's a little bit of the psychology of it and how we need to look back at it, not look at things as missed opportunities, but keep a level head and not FOMO back in. Now, could you buy into the momentum on Chinese stocks? And that was the bottom. They continue to the upside. They're back at new highs, a year or 2 years from now. 100% a possibility. 100% a possibility. But based on technicals, based on my trading strategy and my experience, I don't see anything that has changed for me. The only thing that has changed for me is the probability of success on that trade is still below 50% because it's still bearish. But now the risk reward ratio is exponentially higher risk than reward because we just had a massive move to the upside. So in order to invalidate a retrace of that move, price would have to go so low that if we put our stop loss in place, there would be almost no reward unless we had like a massive target back to the upside, like new all-time highs or something like that. So the risk is huge right now, and the reward is extremely low because they just had a big aggressive move like that. And that is typically how the market traps people. You know, we talked about it the last couple streams in a row. You know, when we're in a bull market, it stairs up, elevator down. When we're in a bear market, it stairs down, elevator up. So these Chinese stocks have been melting down for months, and then all of a sudden, you know, we have 50% moves in a couple of days. So anyway, that's enough of that. A little bit about the psychology and everything, and let's get back into our just traditional technicals, and we'll rip through our regular technical analysis, do our weekly wrap up on the rest of the stock market, and then take a look at crypto as well. And we'll pop off on commodities, look at oil, all that good stuff. So in the VIX also, we did discuss a lot of the indexes and our targets, and most of them are on the way or nearly there. And then the VIX is at a key level that we were looking for as well. So TNX, nothing really changed here. We're still at 2.15, hanging out top of the range. Basically right in line with what we expected. The gap on the 210 is basically it's 2.15 and 1.95. So it's basically 20 basis points at this point in time. So, you know, and we're still hearing, you know, the economy's strong. We don't see any risk of a recession. I mean, look how close the 210 spread is to crossing right now. I mean, if there was ever a risk of recession, you know, it's now based on the 210 spread. I mean, I think we have right here, like was a tighter range where it took a little time to cross. But I mean, how many times do we see where it got that close and then didn't cross? I mean, there was a couple times back here in the 90s where we avoided recession, at least temporarily, but, you know, eventually led to the same thing. So we'll see. We'll see what happens. It's worth paying attention to. Oil, so we got the push back up on oil. Even though we didn't hold the top of the range, we moved back up to 821, closed above the 821, and now we have averted this cross for now. So what we were paying attention to on oil is, do we come back up here to this fib and get rejected and it rolls over? Do we come back up, put in a lower high somewhere else or a double top, and then it rolls back over? My inclination would be, if we push back up here anywhere near the top of the range, that we continue to the upside. As a matter of fact, if we just consolidate here long enough, I think we continue to the upside. I think this got overextended, blew off top, and it's just basically consolidating before our next leg higher. Now, if this level fails right here and it starts to roll over, that might change, you know, everything. But honestly, I don't see anything fundamentally changing with the biggest thing is this move right here all is priced in, you know, issues with supply and demand based on, you know, Russia. So the only thing that changes this dynamic right here and the psychology behind the market and supply demand dynamics is essentially the sanctions coming off of Russia. So in order for that to happen, you basically have to work out some kind of treaty. So Ukraine and Russia have to come to a treaty, and then on top of that, you know, the USA and, you know, UK and a couple of these other countries that have essentially sanctioned or refused to buy Russian oil would have to essentially come out and say, okay, look, if you do this, if you come to a peaceful resolution with Ukraine, we're going to basically look the other way on everything that happened, and then things can go back to normal. We'll remove the sanctions. You'll be back on the SWIFT network. Everything's gravy again. But I mean, if you've ever had a falling out with someone before, you know, the same way two countries might have a falling out, even afterwards, one of two things happens. It either strengthens your relationship because you went through some shit together and, you know, you grow from it, or there's still always kind of like that itching in the back of your mind, like, all right, you know, we're cool now, we're cordial, but how long before you pull some shit like this again? And I think that's the more likely supply and demand dynamics and supply chain issues would all of a sudden alleviate within, you know, a 1 to 2 year period and change the overall dynamics of this. So as far as I'm concerned, this looks like a breakout. over leveraged, over, crowded trade, come back down, consolidate, and then I think it continues to the upside in time. Now we'll have to wait and see, obviously. So VIX, obviously we have our descending channel, and then we have our ascending channel. Depending how you draw this, whether you look at the wicks or whether you look at the closes, it doesn't really matter. We're essentially getting the same picture. You could arguably draw it both ways too. You could have something like this. So if we break above this level, a wick, you would expect to end somewhere around that yellow line. A close on the daily, you would expect to end somewhere around that white line. Doesn't have to be perfect, but I think that's the way to draw it. Now, we discussed this again on the last stream, how we expected basically the VIX to cool back off. We had hit the top of the range. We had maximum fear in the market, at least at the time, based on essentially, is the Fed going to overreact? If inflation's out of control, are they going to do a sudden 50 basis point hike? Even though it wouldn't matter at all. 50 basis points not going to change anything versus 25 basis points versus zero. I mean, we're effectively at zero still. It was at 0.08, and now it's at 0.033, or 0.33 rather, 33 basis points. I mean, that's essentially zero. It's free money still. So we reach maximum fear, at least short term, in these markets. And then now here we are, the VIX is back at the level we were targeting. And what was that level? Well, it was this ascending blue support right here. It was the top of our descending channel. And those two meet right here in this green box area. And obviously I didn't know we were going to get there right away this quick, but that's our target. We hit it. So now what happens from here? Well, this is basically a, key level. If we break through this and come back below and back inside this range right here, maybe that's it. And stocks just go to higher prices. And that was all it needed. This was a false breakout or a breakout that failed. And then we're back inside this range, and then we just keep trending down. What I would expect to happen after a breakout, similar to what happened with oil, we would break out, come back down, hit that key level, consolidate, and then continue the move to the upside. But again, there's, when we get a breakout like this, there's a high probability this level will hold, but there's also, a probability that this level fails, the breakout fails, and then we just enter back inside the range. And you guys know I'm not really a breakout trader. I'd rather be positioned in advance or wait for the break, the retest, and then the beginning of the confirmation or continuation. So what happens in the next couple of days? Obviously, this is a Friday. Stocks are looking strong, going into a strong week. Typically, Monday, we'll see some kind of continuation. What happens essentially is big for the markets, a big swing. So either that was our big push up, or in this case on the VIX, a push down. And then we see a reversal back in the direction of the predominant trend, which obviously this is starting to trend to the upside now on the daily, which would mean stocks going lower. Or this level fails, we break back down, the market is now bullish, and there's enough momentum coming in that, we probably the VIX just cools back off. We come back down, start breaking below all this support, the 200s, the heart line of the channel, the resistance / support of the channel, and then we probably just head back down to the 20s again. And, there's no more fear. Everything's gravy. So what if the Fed's going to, let some of their balance sheet run off? So what if the Fed funds rate's at 25%? So what if inflation's at 7.9%? Who cares? None of that matters. Everything's bullish now. Earnings are going to be great. Forward guidance is great because we know what it is. No more fear. I don't see that situation happening. Doesn't mean it can't happen. So we'll have to see, but we're at the key level we were looking for. So now let's look at Dow Jones. Well, we got our move. What was our expected target? It was either 34,417 or 34,964. Let's just say 35,000, which is just basically a breakdown from the 200 exponential and simple, a retest, a reversion of the mean. And then we see what happens here. If we consolidate here long enough, we probably just stay between these two and ping pong around. If we break back above the 200 simple, we probably look bullish again and then go to much higher prices. And that was it. Everything's gravy now. Does that happen? I mean, I honestly don't know, but I mean, what was our target? Well, we're there, right? This was our target from last stream. Top of the descending channel, 821 cross the upside, retested 200 exponential, potentially 200 simple, and breakdown in green. So is this a fair bear market face ripper rally? And then it just rolls back over and goes lower? My inclination is to say yes, because I'm going to trade with the trend. So if I took a scalp here off the bottom of the range, looking for a reversion to the mean play, which I did not. But if I did, that would be the play, the bottom of the range to the top of the range, from support to resistance. And then we sell into it anticipating a rejection and lower prices. If we are wrong and it doesn't get rejected, consolidates here again, crosses the 200 exponential and simple back to the upside, we would then switch back to bullish, which is fine. We had a false alarm, fake out, fake breakdown, bear market, consolidate, and then we have to just trade with the trend again, which is, if the 200 exponential and simple roll back over, flip blue again, we have to be bullish because that's our trading strategy, regardless of what we think, etc. But, none of this is unexpected. I mean, it seems like when you hear everybody talking and they're like, this is it, the risk is gone now, the Fed's being responsible, Jay Powell doesn't want to hurt the market. You hear all these narratives over and over again, and everybody acts like there's massive volume coming in, and everybody's buying the dip, and this is it, we're going back to new higher prices. If you didn't get in, you missed out, sorry about your luck. And everybody starts feeling the FOMO. But if you plot out these moves in advance and then they happen, you're not surprised. You're like, oh, okay, yeah, sure. That's exactly what we expected to happen. So do we want to come in right now and get bullish at resistance? Because this is when we talked about we want to be a seller. And everybody else talking about now's the time to be a buyer. So, that's how you have to look at it. Based on technicals, that's how I look at it. You can do whatever you want. Obviously, none of this is financial advice. I am not your financial advisor. These markets are extremely volatile, as we've seen with the China stocks. So please do your own research and trade responsibly. Anybody short on China, especially if you're late to the party, is probably feeling the pain right now. Or, way stopped out of their positions. Matter of fact, I'm sure we're going to hear about something blowing up, financially because of those big moves in China. But, as far as I look at this, none of this is a surprise. This is literally what we discussed, what we expected. Move back up 200 exponential and simple on the SPY, looks normal. Looks exactly like what we would expect. Move back up on NASDAQ, kind of underperforming. Obviously, it's been a little more bearish than most things, based on the ridiculous valuations and whatnot. But, our target up here at 14,147. Maybe we get the follow through by end of day. Maybe we get it on Monday. Still very much in a bear market. But, getting that push back up to support, what was support as resistance. And then we would, potentially expect this to roll back over. Now, again, if that doesn't happen, we will reevaluate and go from there. Russell, same thing. Where's our target on the Russell? 2130. So it's underperforming compared to Dow Jones and S&P, which makes sense because they have been more bullish. Russell and NASDAQ have been more bearish. So then when we get a bullish move inside of what is potentially a bear market, we would expect those that were more bullish to remain more bullish or become even more bullish in comparison. So, we would expect the bear market stocks that have been laggards in the bull market to continue being laggards on a, bear market rally, which is what we're seeing with NASDAQ and Russell. But we do very much still expect a retest of the bottom of the channel on the Russell and that target. And if you didn't watch the last stream, at the beginning of the stream, we went into deep depth on the Fed and what I expect going into the future. But we also talked about all these targets in advance. So now in hindsight, sure, oh yeah, of course you think now it's going. Well, we put all these targets on here last stream. So you go back through and look at it, listen to what I was saying and why I was saying it and expecting it. And then we can see that, this was all essentially what we expected based on the VIX, based on, key support levels, based on everything that happened and what was already priced in. And, is the market going to be right long term? It's strange how you think about it. The market is always right because it's the market and it's everyone voting. And then when it's all said and done, you count your dollars, count the votes, and that's it. But retail is the one that's buying the majority of this. And retail is almost always wrong. So we see strength in retail, a bunch of retail buying off of this right now. So right now, retail looks like geniuses, but, institutions are waiting for actual technicals to line up as well. So I think I might even made a statement about the market always being wrong. And I hope I didn't make it in a way that contradicted myself. I essentially was talking about more like short-term, like retail, not really like the actual market as in, voting machine. So let's look at some of our other indices, or sectors. XLE energy, obviously we're seeing that push back up to the upside, the reversion, trying to stop that 821 from happening. Nothing has really changed for me right here. Now we have reclaimed a key level, so maybe consolidates and we do go higher. As far as now, we have averted the cross to the downside, so that does look good. Similar to oil, I look at oil as basically, that the XLE. So whatever oil is doing, we're probably seeing something very, very similar in energy sector. So we've taken some profits off the table, have not re-entered into the positions that we took profits on. Have to look at it as there's obviously multiple ways that you can invest in oil. I like the XLE specifically. Now, granted, though, 50% of that is, almost 50% of it is like Exxon and Chevron. So could you just invest in Exxon or Chevron? Sure, you could. You get a little more diversity. Do you want to be invested in producers? Do you want to be an investor in, the other portions of, the supply chain or downstream or upstream mechanics of it? That's up to you. That's really up to you. I like a little bit of diversity, but I don't mind with some of those heavily weighted ones, as long as what's most heavily weighted is what I'm interested in. Now, if we're talking about semiconductors and we start looking at it and I see something like, Intel has an equal weighting to something like Micron or, one of the other stronger ones. If I see an index that has NVIDIA weighted equal to Intel, I probably don't want to be involved in that because I want to be heavily involved in the winners or heavily invested in the winners, not as equally heavily invested as in losers or something that hasn't hit a new all-time high in 20 plus years. So that's the way I look at it. So it can look, as long as you know what you're getting into with some of those sector funds or ETFs or whatever, it's not bad. Just make sure you understand what's inside of them and how they're weighted. But you could just as easily say, well, I don't want to be in all that other junk. I'll just, take a position in Chevron, a position in Exxon, and go from there. Maybe you're like, I don't like Exxon, or I don't like British Petroleum because of things they've done in the past or whatever, so I don't want to be involved in them, so I'll just pick what I like. That's totally fine. So XTN, transportation sector, looks like we're reclaiming 200 exponential and simple. 3 pretty aggressive green candles in a row. Left a slight gap, nothing too crazy to be alarmed at. So we obviously have the potential target for a breakout to the upside, which is essentially just from the bottom of the range to the top of the range. As of now, we have a technical breakout. So technically our target would be a retest of this previous level right here based on the measure move. Now, do we get there in transportation? I don't know. I don't know that we get there. Maybe we do, maybe we don't. As far as I'm concerned right now, though, we are trying to reclaim these levels. So if we cross this 200 exponential and simple back to the upside, it's going to look bullish. I mean, all the markets look very bullish today, the last couple days. Short and medium time frames. Not much has changed, obviously, long time frames. XLF, financial. Again, we're seeing very similar, breaking back above those levels, reclaiming the 200 exponential and simple. They're basically flat at this point in time. They were slightly bearish. Now they're slightly bullish again. Looks okay. Again, same thing. Is this changing how we look at these markets? Is this now immediately a buying opportunity? I mean, you have to make that decision for yourself. Do you think we're going to get continuation here? Are we seeing what we would expect? Are we seeing volume picking up? Are we seeing, sustained buying coming in? Does this look, over these last couple of days, do we see volume increasing or decreasing? Well, we see it decreasing. What does that mean? It means that less people are buying, or it's all buying and no selling, or a combination of those things. There's no selling taking place, all buying, but the buying is declining. So we would expect to see buying increasing as it looks bullish again and people are re-entering positions. Are we seeing that? Not really. Did we see a volume spike at the bottom of the range, telling us that this is the bottom? Not really. We saw volume pick up some. On a longer time frame, does it look more aggressive? Well, we sort of see, a volume spike here. That was our bottom. See sort of a volume spike here. That was our bottom. But what is this really? Is it just a retest of the 8 and 21 trying to avert the cross? Is it just a retest of the daily 200 exponential and simple trying to avert, the downtrend? That's what it looks like to me for now. Does not mean we don't get bullish on these things again. XLC communication, looking like a double bottom off of the key Fibonacci levels. We obviously have this red resistance, potential 821 crossback to the upside, potential target of the breakdown at 71. Again, still looks very bearish, but, having a nice little bounce right here. See, none of these are changing my technical view of the chart. XLP, consumer staples. You could arguably stay bullish on consumer staples, obviously because of fundamentals and technicals. You guys know that this is one of my, recession or, safety plays in a downturn. I don't love that this broke through the 200 exponential and simple, but very easily could just go to new highs after this. If I was looking for something to be bullish on in this move right here, I would be bullish on something that has tailwinds as well if we're wrong. So if we avoid a recession, everything's gravy, we go back to the upside, the market was spooked, but now everything's fine again, XLP is a good place to be. If we're right though, and we do go into recession and people got to tighten their belts and they have less discretionary spending, what does well? Well, still consumer staples. So for me, this one looks good, looks better than most. Finding support at a key level, eventually hitting, our green box level, bouncing 200 exponential and simple. I would rather be involved in something like this. XLU still looks strong, consolidating at all-time highs. Again, nice safety play, looks decent. Looks good, looks better than most, honestly. XLRE, again, even with rising rates, still looks good. I wouldn't want to be in commercial, but residential, potentially something like this, or, cash generating, dividend stocks, looks good. Reclaiming 200 exponential and simple. Now, could this easily just roll back over, put in a lower high, and then go into a bear market? It 100% could. But as of now, it looks like reclaiming key levels. VWO, obviously, big move. China and everything going on here. China is, I think, like 50% of this fund. I should have looked, but I believe it's like 50% or almost 50%. Back here, reclaiming key levels. We discussed this, how I would expect it now to kind of chop around between the blue support and the green resistance. And then whatever direction it goes from there is probably the direction it continues in. But again, 200 exponential and simple, way back up here at 50. DAX, Germany, nice little bounce right here. Again, getting close to confirming the 821 back to the upside. Bunch of green histograms, hard buy signal. Still below resistance. Still in a bear market very much. But, looks like we're probably going to get a reversion to the mean play. Back to support, which is now resistance. Back to the heart line, back to the 200 exponential and simple. Somewhere potentially another 10% to the upside. But we have to remember, these are counter trend trades. Any of these trades we take potentially right now are counter trend. Doesn't mean they're not nice trades, but they're counter trend. China we already looked at. UK been going pretty aggressively since the bottom at that key Fibonacci level. So we hit the 382 perfectly with a wick. So is that the bottom and now we just rip to the upside? Possibly. Possibly. Reclaiming the 200 exponential and simple. Starting to look much more bullish. EWZ, Brazil, reclaiming 200 exponential and simple, bouncing the 200 exponential, reclaiming that key Fibonacci level, back on top of, key Fibonacci. So a weekly close back here, it's going to look pretty good. Back above the 200 exponential and simple, back above the key Fibonacci level. And then what's our next target? Well, probably a retest up here at 41. And that is obviously our spread. So let's do these real quick and then I'll jump in chat. So DXY still, I would expect this to still be under pressure. I would expect something like this, basically consolidation and then lower, and then eventually, move back to the upside from there. I know there's a lot of scares because Saudi Arabia and, China and people potentially doing things outside the dollar, but this is still very, very bullish to me. 821, still very bullishly postured on the weekly. green histograms. We're seeing the stochastics go down, trend to the downside, while price goes up. So, that's obviously we're seeing some divergence between the indicator oscillators and price action. But this to me looks like a bullish reset. If price is going up or sideways while the indicator oscillators go down, that's basically just fueling up for the next big rally to the upside. So, we're at key resistance where we would expect to run into resistance. We were pretty aggressive on the daily. But overall, monthly looks very strong, very bullish. Everything looks extremely bullish to me on the DXY. But I do expect further consolidation and downside. Probably closer to like 97, which is good. This is good for the world. The dollar can't just be strong all the time and the world be healthy. That's not good. Tesla reclaiming 200 exponential and simple. Hasn't looked particularly great lately, but reclaiming up here, consolidating. This is going to start looking okay again. If the 200 exponential starts rolling back to the upside, Tesla's going to start looking good again. Now, am I rushing back in looking for these? No. I mean, again, nothing has really changed for me on these. We looked at all the Chinese stocks already. So ARK had a nice move the last couple days. I'm sure Kathy's loving it. Probably feels like a genius. I would love to check out her Twitter and see what she has to say. Up 26%. I'm sure she'll be like, ARK is up 26%. We might have been down 50, but now we're up 26%. But, she obviously would be deceitful and not talk about the fact that even after the 26% move, still down 58.9%. So it is very important that we remember, the downside damage is exponentially worse than the upside afterwards. Because in order to get back to, talk about, it's up 26%. In order to get back to that all-time high again, it needs to go up 206%. So 60% down, 206% up to get back to even. But again, very much below 200 exponential and simple, 821, trying to potentially cross back to the upside. Again, what is this? Is this a reversion to the mean on the weekly? A retest of a 200 exponential and simple before continuation to the downside? That's what I would expect. That's what I would expect. But I mean, we are seeing some of these stocks reclaiming those key levels. I think the big determinant for me and what would change my overall outlook on the market is what the indexes do. If I see the Dow Jones and the S&P reclaim the 200 exponential and simple and flip the slopes back to the upside, I will inherently be bullish once again on the market. When I see an individual stock here or there do that move, while it still looks like we're just having a reversion to the mean play on the big indexes, I give it much less credit because it just looks like, well, it's just more bullish than the market is, but the market is still overall bearish. So that to me is the big determinant. So SMH, Vanex Semiconductor ETF, reversion to the mean play. We'll have to see what happens here. Does this roll back over and go lower? That's what I would expect. But if we reclaim this level, consolidate, semiconductors start looking good. Transportation starts looking good. Yield curve doesn't look like it's going to invert. Oil cools back down or just kind of goes sideways. Maybe we avoid the four horsemen. It's never happened in the past, but maybe we do this time. Or maybe we just, prolong it. It takes a little time and then it happens. NVIDIA, we're getting the breakout we discussed on the last stream. Measure move to the upside obviously is the, bottom of the channel to the top of the channel. I did not enter into more of a position on NVIDIA only because, now I have a core position on NVIDIA, semiconductors in general, but mostly NVIDIA. We missed my target slightly. But we did. If we would have gone slightly lower, I would have taken an entry on NVIDIA, but we missed it, which happens. It's fine. It's running away from us now. I'm not going to FOMO into it on the breakout. If we hit that measure move to the upside now, how much more of a move is it? Well, 23%. So should we take a buy into momentum? A little scalp play on this? Do we want to just set our stop loss back if we break down into the channel? We basically take a stop if we break back below into the channel right here, but we have a favorable risk reward to the upside momentum trade. 7% stop loss. If we break back down below it, 23% upside, 3.2 to 1 risk reward ratio. There's definitely a argument to be made for that. Momentum in our favor, hard buy signal. I'm a strong believer in NVIDIA. So there's definitely some potential. Netflix is next. Obviously, Netflix had a nice bounce here. I did see some bearish fundamental stuff on Netflix, which is, I don't weight heavily But it seems strange to me. Obviously, Netflix been around for a long time. Obviously, everybody and, their family shares Netflix, friends, whoever. And they've done some various things over the years to stop multiple people at multiple places from being logged in at the same time, which is, it's understandable. They don't want, people basically just sharing their Netflix and then everybody just using it on one account. But now they're like going hyperbolic in an attempt to crack down on people like sharing Netflix. So now it's not even going to be, you can't be logged in at the same time. Now they're going to go after, your geolocation and figure out, hey, why, if you were using Netflix in New York at noon, how could you possibly be using Netflix in San Francisco at 2 p.m.? So we'll see. We'll see how that reflects on their business. We'll see how that reflects on people. They're obviously raising prices, trying to cope for some of this, trying to crack down on people that are using, abusing, whatever. If you agree not to do it and then you are you a bad person? Technically, sure, whatever. Does everybody do it anyway? Sure. How does that change the overall outlook on Netflix? Well, I mean, I don't know if it pisses people off and then they cancel their Netflix. I don't know if more people say, well, I guess now I have to buy my own Netflix since I can't use mom's or, whatever. What if you're a legitimate Netflix user and you just take a flight across the country and then you go to log in and Netflix is like, no, you're a cheater. And you're like, yeah, but I mean, this is my Netflix account. I'm just in a different place now. And they're like, yeah, I don't believe you. I mean, how are they going to verify that? I don't know. But it seems to me like a little bit desperate that you're potentially going to piss off the people that have your service to try to make sure that people aren't cheating your service. I mean, we'll see. We'll see how it plays out. Seems like a desperation move to me. Netflix actually, obviously, has taken quite a bit of damage. It's at a key resistance level again. This is where we topped out multiple times back through like 2018, 2019. So it's going to be difficult to get back through this level once losing it as support. But, again, still looks very, very bearish to me. We are back above the 8 and 21. If these cross back to the upside, do we get that reversion to the mean play? Do we get that gap fill back up to 500? I mean, it's very possible. It's very possible. I am not buying Netflix, but if you presented this chart to me and said, okay, look, I'm looking at basically, I don't even have to do this because we already drew it. So you can tell I just do the same thing over and over again. I mean, if you've been following the channel for any amount of time, you probably don't even need me anymore. I mean, it's probably fun to get on and have conversations and watch the streams, but let's be real. You could just watch my old streams and then be like, oh, he just does the same thing all the time. I'll just do that because obviously it works. So what we said was if we reclaim this key level and consolidated here back above the 821 and potentially got the cross, we would want to take a potential move back to the upside for the reversion of the mean play. And then what we would be looking for is a breakdown back below the 8 and 21 as a stop loss, and then a target, obviously, for the reversion of the mean gap fill for a, scalp, obviously, which we would expect because we're in a bear market. We would expect something like, what am I doing? We would expect something like this to happen, where we basically bounce around, get the move back up here, and then bounce around and then get rejected and then go lower. That's what I would expect to happen because we're still very much in a bear market. Doesn't have to happen that way. We could easily reclaim that level and then just go much higher. But with a 35% reward, 7.5% risk, or arguably, if you didn't like where I put that at, you could move it down lower and say, if we put in a new low, I'm going to be out of this trade, but I expect us to go higher. So it's a 3-to-1 risk reward ratio still, or 2.65. That would be fine as well. I think this would be enough for me. But that is a, 4.59 to 1 risk reward ratio. So again, if you put that trade out there and said, okay, this is what I'm looking at, I wouldn't criticize you, obviously, because I put that same trade set up here in advance. So again, I mean, that could be a nice trade, obviously. I don't love Netflix, just in general. I don't really see the future for them. I think there's too much competition for them. So does Netflix ever get back to new all-time highs? I honestly don't know. I would say probably not anytime soon. But, arguably, this would be a nice trade. especially if it works. If it doesn't work, it would still be a nice idea for a trade. It just didn't work. But if you get to flip the coin once and you get $5 if you're right, $1 if you're wrong, you lose. Is it worth it? Well, that's pretty good risk reward trade setup, I'd say. Probability of success is less than 50% though, because we are technically in a bear trend. Apple bouncing that key level, red support right here, bouncing 200 exponential and simple, back above the 8 and 21. But resistance we would expect to be 164. Now, if we break out from that, then again, we would have to start looking at, let's just take the meat of the channel, a rather conservative move. Rather, obviously it's getting wider towards the bottom. But if we get up here and get that breakout, it takes us to new highs. So if we are able to consolidate back at the top of the range at like 165 and we break out, we head to 200. Let's be real here. I don't know what the actual target is, but in all reality, 187. And then obviously we have our long-term target is just above 200 or at 200. We probably go there if we break out of this channel. So, and again, I would rather be buying into some of these stronger ones that are not as beat down, that have performed well overall because they've held up so well. If you're wrong, I think you have less risk on the table. Then obviously there's less reward, but there's a lot less risk in my opinion. So Microsoft is going to look like a sort of a V bottom right here. If we break back above the 200 exponential and simple, or even get above like this $300, 305 range right here, we're probably going to look at essentially like a W double bottom, which would basically give us a move back up here. Now, potentially that puts in a lower high. It definitely would invalidate our head and shoulders, which is completely possible. But would give us a move back up to like 334. So, another 10% to the upside. Looks strong. Above the slope line, couple green histograms, hard buy signal, approaching the 0 line. 821 look like they're ready to cross back to the upside, reclaiming the 200 exponential and simple. Again, the truth is, like, are we going to get follow through on these? But right now, they look a lot better than they did. Amazon, a reversion of the mean play back to 200 exponential and simple. This is a tough one because I think it has a lot of headwinds if we do go into a slowing economy. I don't think people just stop using Microsoft services or purchasing, software from Microsoft, etc. I don't think they're just going to cancel their business accounts or stop using Microsoft products if we go into a slowing economy, business or consumer wise. I don't think people stop using Apple. Maybe they don't buy as many iPhones or as many iPads, but let's be real. Those things break all the time. People drop them. They get outdated, whatever the situation is. People look at these as a necessity. I think Amazon purchases in general are more discretionary. So I would look to something like Apple and Microsoft as more of a place I would want to be involved than something like Amazon. I would look at something like, and again, this is just reversion of the mean play. I would look at something like Google as somewhere if I was going to pick out of Netflix, Apple, Microsoft, Amazon, and Google, I would rather be in Apple because of what I just said. I would rather be in Microsoft because of what I just said. Apple more of a consumer reason. Microsoft more of a business reason, but also consumer. And then Google, I think if the economy slows and people aren't spending as much money, what are they probably doing? Well, they're probably still using YouTube. They're probably still using Google. Is the ad revenue going to go down on those sites? Possibly. But is the traffic going to go up on Google, YouTube, whatever? Are people still going to be using those services equally? Or is the traffic going to fall off a cliff? I would say it probably still stays the same or goes up. Because if people get laid off, what are they going to be doing? Probably wasting time on Google or YouTube or, whatever. Maybe watching Netflix. I don't know. I think as people tighten their belts, they're going to use a lot more of these services. Arguably even like Facebook or Meta or something like that. So the ones that make money off the ad revenue versus the actual consumer would still do well in a slowing economy. Because even though the businesses aren't doing as well, they're going to probably still spend a decent amount of money on ad revenue to try to cope for lack in sales or whatever. Now, will it drop off? For sure it will. But what's going to suffer more? Somebody that relies on purchases from the consumer, or somebody that relies on ad revenue from the people that want the consumer to buy stuff? I would say probably the actual ones that rely on, purchasing revenue or sales. So I would think Google will stay strong. And again, we see that reflected in the actual charts here as well. Amazon's chart looks much worse than Google's chart does. Apple's chart looks much better than any of the others. Microsoft's chart looks much better than Amazon, about equal to Google, not quite as good as Apple. Netflix chart looks, terrible and probably closer to like Amazon's. So again, we're seeing that reflected already in the charts and in price action. The only difference is, we have a legitimate reason fundamentally and technically now that lines up. And that's why, we basically are talking through this. So let me jump over in chat and then we'll do some crypto here. Let's see, where did we leave off at? Big D says, yo, just got notification about the stream. What's up? What's up, Big D? Sohel Tone, appreciate you, man. Time you take and share accumulated knowledge and insights. Learn a lot from you. Bless you. God bless you too, brother. Appreciate the kind words. Lazy boy. We are in the twilight zone. I'm in the Apple cult. We are devout followers. Yeah, I mean, it's true. It really is true. I mean, it's realistically though, once you get into Apple products, you're more likely to continue buying more Apple products. And same with a business that's using, like Microsoft software. Are you going to like all of a sudden one day be like, man, I'm tired of Microsoft. I don't want to pay for their goods or services anymore. I'm going to switch to something else. Good luck. Well, like, what are you going to switch to? Fuck out of here. Okay, let's go with commodities now. Matter of fact, let me just take a drink real quick and then we'll keep ripping. Lazy Boy says invest in something you buy. Yeah, that's never a bad idea. Unless you just have horrible taste and you just buy garbage. Then you're screwed. You're double screwed. All right, so crypto. Let's talk about what's happening right now. So it looks bullish. We're moving up. It's like, oh, let's go. It's happening. But has anything really changed? We got the cross once, got rejected. Got the cross twice, got rejected lower. About to get the cross again. What happens? Probably get rejected lower once again. We're still just operating inside that pattern. Remember what we said. We buy support, we sell resistance. So when this pushes up here, now granted this is a future chart, so it closes in about 2.5 hours. But, assuming we get up here now, or maybe it happens on Monday or whatever, in all reality, 43,325 is the top that we would expect based on the descending resistance for our pennant, and then also our key support / resistance on the horizontals. And then if we turn off the drawing tools and we just switch back out to the weekly, we see this is basically the retest of the 8. We would expect, 43,740 for the top of the weekly. And then here's our monthly. And again, what are we doing? Still just range bound. I mean, we said it a bunch of times already, but I'll say it again. As far as I'm concerned, we are range bound between 37.5 roughly and 40, let's say 5,000 roughly. I would expect us to just continue bouncing around up and down, up and down, up and down until we finally break in one direction or the other. Now, what direction is that going to be? I mean, we'll have to wait and see, obviously, but that's what I'm looking at. So now I want to actually, I know I don't normally go down to short time frames on the streams, but I want to look at the 4 hour. Because going into the weekend, this is what I was talking about, where we cross back on top of the 4 hour and potentially, stop the bear trend. So here we did it once. We switched to 200 exponential and simple back bullish, came back down, then we put in a lower high and we lost support. Here we did it again, switched to 200 exponential and simple back to the upside, came back down, lost it, attempted to break back up, put in a lower high, lost support. So now here we're doing it once again, potentially getting ready to flip the 200 exponential and simple back to the upside. At which point in time, anything could happen. We could consolidate and then break to new highs. The levels we'd be looking at is 1, 42,500, then 2, 44,500, and then 3, slightly higher at 40, say 5,000. But again, we're still just operating inside that same range. So when we talked about why we didn't want to put in a short down here at support, because we were potentially in a 20% range so we could move back up to the upside, well, I mean, we're just doing that. And we have a resistance. It's going to be tough to see with this triangle, but if we look at this resistance, basically, we broke through 1 touch, 2 touch, and then the 3rd touch came back down, retested it, and now it looks like we're getting that move to the upside, as we would expect when we break through a key resistance. So where does that move to the upside take us? Probably up to like 45,000. Now, typically, we used to see bullishness over the weekends, as the adults were gone for the weekend and the kids would like throw a party. We haven't seen that in a long time. So is this going to be the weekend where we actually run up and get an aggressive move? I don't know. I mean, maybe we get up to 45,000. I think that would be the first sign of life back in the crypto market and would look good. But, it's been week after week after week of just not seeing bullishness over the weekend. So I don't want to get too excited about it, but I think there's a possibility we go up to 45,000 over the weekend. I don't know if it's sticky, but what is it really? Just a retest. Just a retest of 200 exponential. Now, again, if we start taking out these key closes at 44,594 on the daily, it's going to start looking like a ascending triangle with a flat resistance, which is typically a bullish pattern. And then, we would have a measured move break back to the upside if it broke out bullish. Now, I would be obviously inclined to say that's less likely to happen because typically you see a downtrend, a consolidation, and then continuation in the direction of the downtrend. And then obviously on the daily, we're still very much in a bear market until we close back above 48,700. So again, this is a less than 50% probability trade to the upside because we're trading against the trend. We're jumping off the inner tube for a little bit. We're still floating downstream. The cooler is still floating. Our buddies are still floating. Everybody's drinking beers, but we got tired of laying in the inner tube, and now we're going to swim around for a little bit. So we're going to take a little scalp to the upside. Nice little move back to like 45K. Nice little 7, 8, 10, 20% in altcoins, whatever. And then we're going to get back on, and we're going to float back downstream again. That's the way I look at it anyway. Maybe we break up back up here, and then we take some off the table at resistance. We take some more off the table, at resistance again. And then we have our measured move. And then we take more off the table there. And then if we hang out long enough or get a retest and it holds, then we can start getting bullish again if we cross this back to the upside. Again, that's how I look at it. So Ethereum broke finally for the first time above that descending orange line. So again, we have our next descending line right here in red. That's where we would expect our target to be, which is obviously 200 exponential is at 31.6, 31.61. 200 simple is at 35.26. And that's probably going to line up roughly with that descending red line as well. Still very bearish, very much inside of a bearish downtrend. But starting to look like basically a potential like W, double bottom right here, which obviously if we break through this neckline, which is roughly where we're at right now, this would be our measure move, and it would take us probably back up to that target. So what would the move be on something like Ethereum? And obviously the altcoin's probably going to outperform, but something potentially like 20% move to the upside. So, is there a trade set up here on Ethereum? Potentially from where we're at? If we start closing back below the 821 and that resistance, 7% stop loss with a potential target up here of around 20%, roughly 3-to-1 risk reward ratio. Again, I wouldn't be afraid to take this trade. I don't love it. It's counter trend trade, but it's a reversion to the mean trade. Not a bad trade. I mean, even if it succeeds only 40% of the time, let's say, 60% of the time it fails and we get stopped out. If we take this trade 100 times, 40 times we're right and 60 times we're wrong. But we risk 6.75% and we gain 19.7%. So on the 40 times we are right, we gain 3 times as much. So 40 times 3 is 120. and then we take away the 60 times we're wrong, and we bet $1 each of those times. So we still end up with a 2-to-1 risk-reward ratio, even with a 60-40 success to failure rate, if that makes sense. So essentially what we do is, and again, we don't know the probability of 60-40, but I mean, I think that's a fair assumption. It's over 50% likelihood that the trade fails because it's counter trend. But at 60-40 ratio, we're basically giving, roughly a 2/3 probability that the trade fails, but we're risking 1/3 as much as we're getting rewarded with. So when it's all said and done, and we factor it out at a 60-40 or arguably like 66-33, when we do the math on it, we still actually end up closer to like a 2-to-1 risk-reward ratio on 100 times taking this trade. So even though it's a counter trend trade with a high enough risk-reward ratio, we can still succeed. Now, I don't want to necessarily take a 2-to-1 risk-reward trade against the trend, because it really starts to, again, if we get to like that 60-40 or 66%, it really cuts into like the margin of gains, assuming that we lose more often than we win, but we make still more, but not enough more to make up for the margin of loss. So with at least a 3-to-1 in a counter trend trade, we don't have to worry about that. Now, if this is a 2-to-1 trade, let's say, and we get $2 if we're right, $1 if we're wrong, the risk reward is not as favorable, and the probability is still the same, let's say 60-40 again. If we're right 40% of the time, we would make $80 because we would be getting 2-to-1. And then if we're wrong 60% of the time, we would lose $60 because it's, the $1 we're risking. So we would lose 60, we would gain 80. So then we would have a net profit of $20 on 100 trades doing the same thing, exact same trade 100 times. So is that probability high enough that it makes it worth it? No, it's not, because it's below the 2-to-1 risk-reward ratio by the time we take into the probability of success. And if we do something like a 66-33, it's basically a coin toss at that point in time. Because if we take 66% chance of failure at $1, it's 66. And if we take 33% chance of success at 2-to-1, which is obviously for this example, we're at 66. So what are we really at? Well, we're just dead even. It's just a coin toss. So again, we're looking for, in a counter trend trade, a higher risk reward ratio to compensate for the higher chance of failure because we're trading against the predominant trend. And again, the same thing on the way up. If we're in a bull market and we're taking a trade, we don't need as high of a risk reward ratio because we're trading in the direction of the trend. So we're more likely to succeed. So we need less reward to compensate for the risk. Hopefully that made sense. It's better when I illustrate it, obviously, but I think most of you guys are pretty familiar with risk reward and probability of success, etc. And that's why position size is so important. If we just take one massive trade and we're wrong, we can mess our account all up. If we take 100 small trades and we're just right over time, there's so much less risk because we're taking those 100 trades. Because it's easy to be wrong 5 times in a row or 10 times in a row. But on 100 trades, the probability is going to play out much more, much more in line with what it should. Because it's easy to be right a few times in a row or wrong a few times in a row. You could arguably call heads or tails and be right 5 times in a row. But the probability of you being right over 50% on 100 coin tosses is very low because it's 50-50. The same way if you did 1,000 times and then you checked at the end of the 1,000 times how many were heads, how many were tails, probability would tell you it's probably going to be something like, on 1,000 flips, it's probably going to be like 503 heads and 497 tails. But if we only flip the coin 10 times, could it be 8 heads and 2 tails? Yeah, it definitely could. But we're never, almost never going to see on 1,000 coin flips that it was 800 heads and 200 tails. We will almost never see that happen. But on 100, is it possible that you get 700 and 300? Again, very, very unlikely, but possible. But the higher the sample size goes up, the less chance there is of a crazy outlier amount of, those high skewed data in one direction or the other. So Bitcoin weekly dominance, again, still above the 200 exponential and simple. cross to the upside now. Still very bullish. Looks like it's kind of topping out here a little bit, telling you that alts may be going to run. Still would not be surprised to see this have one more test of the bottom. We do want to see this level hold, though. And the target to the upside, at least short term, is still 45. Total market cap back inside above the 8. So a weekly close. Obviously, this will run over the weekend, but a weekly close above 1.79 trillion will look good. We would expect resistance at 2 trillion. I don't think it will close back above this. If it does, it's going to start looking better, obviously. I still think that overall this looks bearish. But again, we have left the bearish control zone. So, we're kind of just consolidating here, trying to push back up. But realistically, until we get above this previous swing of 1.9 trillion, until we get above the 21 on the weekly, it doesn't start looking juicy to me. Now, if we close back above the 21 and we get back above 2 trillion market cap, crypto is going to look a lot better to me, in my opinion. And that would be in line with us being back above like the 200 exponential and simple and the slope starting to roll back to the upside. And then we would reevaluate from there. Again, you guys know I don't hate crypto or anything. We're just looking at the technicals. So Solana had a nice bounce. Obviously wanted it to get down here lower. It did not happen. It is consolidating above the 821. Looks like it's going to have a potential move back up to resistance for 8%, which would be 98.50, and then back to the top of the range probably for 20%. 108, maybe to the 200 exponential. 113. We'll see what happens. If crypto is strong over the weekend, we're going to see these alts pop off. Honestly, that's what I would expect. Avalanche reclaiming that key support. Looks like it's going to tag the 0.5 very soon. 87. Looks very likely that it moves up here and gets to like 92. At which point in time we would expect resistance, as that is the top of the range. Matic looking like it's going to attempt a breakout here. If Matic does close this daily above that resistance, it's going to look very likely that it's going to have a powerful move up here, probably back to the 382 at 1.6, $1.60, or somewhere between the 200 exponential and simple, as high as $1.74 roughly. So this looks like it's probably going to have 7 to 15% move here, assuming it stays looking the same way it is. Luna, it's not really doing much up here, but still consolidating at the top of the range. Looks like a bullish reset, holding support. Still looks much better than most cryptos, so probably retest the highs. I mean, it's holding the 21. I mean, it really just needs to close back above like 88, let's say 25, and then it starts looking good to probably retest the highs. But who knows? This one has been overperforming when everything else was weak, so we might see some of the steam come out of Luna and then go into some of these other shitcoins, and then this underperform while they overperform. Because oftentimes that's what we see in crypto. One random shitcoin will be doing well, and I don't know what Luna is. Maybe it's not a shitcoin. Maybe it's like, it's great. One random crypto will be doing well. Everything else will look like trash. We saw it with Avalanche. We saw it with Solana. And then all of a sudden everything else starts doing well, and then those will look like trash. They'll underperform. So you have to kind of be dynamic in these markets. Theta at resistance, held the heart line here. We see this yellow descending resistance. We talked about this move potentially. A break above this and consolidation could easily give us a move back up to the 236. Again, it would be like 24% upside with 6% downside. Not quite there yet. If you want to get super bullish on Theta because everything else is breaking out and looking good, you could take a entry from a lower point and look for that same trade. Again, we could look at something like this. Maybe we put a bigger stop in, and a close below these previous resistance or support levels would tell us, hey, this isn't working, and then still look for that same target to the upside. So 10.5% downside, 33.65% upside, a little over 3-to-1 risk reward ratio. I think that would be probably acceptable. Looks like it's got momentum in its favor. Looks okay. Theta does. We'll see though. We'll see how everything does. Crypto has really sucked over the weekends lately, so maybe this is going to be the weekend where it finally does something. So gold is obviously the air is coming out of gold. It had that move to the upside, had its bullish day, came back down to key levels at 1900, and now looks weak. I think it does hold either. It doesn't look like it wants to hold this level. Based on today's candle. A couple hours left in the day. If it closes above 1907, it's going to look okay still. If it starts running down here over the next few days or today or into next week, it probably does retest 1866. If it can't hold 1866, it has to hold the 200 exponential or simple. If it can't hold that, it's going to look really bad. And let's be real. We know what gold is. Gold is a safety trade and it's a fear trade. So if stocks and cryptos are doing good, gold is going to get shit on. So if it's risk on, let's go. You know, China, NASDAQ, crypto. I mean, the steam is going to come right out of gold. And it's just going to look like a massive double top. So, but you guys know what I'm paying attention to. I'm paying attention to this, you know, descending channel on gold, potentially carving out what would amount to a cup and handle. You know, this being the handle and the cup obviously being the double top that we saw right here. Silver, again, going to underperform, probably worse than gold. And again, it looks worse than gold right now, but 24 would probably be the target to the downside. Really wanted to see this hold the heart line. 821 looked like they're probably going to be crossing to the downside. So we see gold-silver ratio on the weekly. Again, still just, I mean, it looks like it wants to get rejected. It looks like silver is going to start outperforming gold here on a weekly. But at the same time, we'll have to see. It looks like we'll probably bounce this area over like the next week or two, just because we see the histogram coming down to the slope line on the TJD, TDMACD, and we typically get a bounce there. So it's probably going to come back up, retest the 200 exponential. If it doesn't reclaim the 200 exponential, it's probably not going to ever make it back up to try to fight that 200 simple. So that was probably just our one-time rejection. But as long as we're putting in higher lows, this still looks okay to me for further upside. Because it looks like we're basically just smashing 200 exponential, higher low, smashing 200 simple, higher low, you know, smashing through the 200 exponential, not quite making it to 200 simple, same close though, and then higher low, and then, you know, we're probably just going to keep moving here. And the longer we consolidate at this range for, the more likely we are to break through it. Now, I don't have some massive target to the upside still. You know, I really thought, we topped at the 382, I really thought we would make it to the 0.5. We didn't get there. You know, obviously I had my target in place. I had the B in place before silver starts gaining. I thought we'd make it to 90. We have not gotten there. I don't think we write it off yet. But from 77 to 90 is another like 20%, you know, move in silver to gold ratio. So, you know, 20%. If this moves bullish here, gold becomes 20% more valuable compared to silver, or silver loses 20% of its value compared to gold. That's what I'm expecting. But maybe it doesn't get there. You know, I can't always be right. Let's be real here. Definitely am wrong sometimes. So maybe that was it. A 382 top would be fully acceptable for a, you know, basically bullish, more bullish retracement or more bearish retracement, depending on how you're looking at it, if you're gold or silver. But that would very, very much be acceptable on technical level for silver to then just start gaining strength compared to gold. But again, that would probably be a bullish breakout, not a bearish breakdown. So pot stocks had a nice little move, a couple percent. I mean, still underperforming, but starting to look better. You know, another cross at 821 right here. Probably going to look like another fake out potentially. But, you know, I really am still bullish on miners and pot stocks for like the next big potential trade. So we'll see. We have triple bullish divergence on the TJD, TDMACD. We're above the slope line. The slope line's blue. We got a couple green histograms in a row. We got a hard buy signal. Potential 821 cross. I mean, if we close this week above 886, we probably see after hours trading, we probably see these start moving up. And again, if we take out our local high right here at like $8, this is the THCX, but you know, we could look at any of these main players. I mean, the reversion of the mean trade is probably going to put us back up above what, 1060. So maybe like a nice little 50% move to the upside. More on some of these pot stocks that are just beat down. CCJ retesting the highs, you know, obviously confirmed the breakout, came back down, and then just back here at the same level again. I mean, if this keeps consolidating at the highs, it's going to look like it wants to go higher. I'm skeptical here. But, I mean, momentum is technically in its favor. You know, I don't want to get too greedy waiting for another pullback to reload on these. The monthly close was at resistance, and we still have about 2 weeks left. Let's look at the weekly close now. The weekly close is just going to look like a double top. Looks okay, though, hard buy signal at resistance. I mean, this looks like it wants to get rejected here. And the reason I say that is we're potentially at resistance for a double top. We're getting the hard buy signal, which looks okay. The knife is pretty elevated right here, so that doesn't look terrible. 821 across the upside looks good. But then when I look at this, it looks like we're coming back up to retest this, and we almost always get rejected right here. And then when I look at the amount of momentum it took to get to that level previously, and the amount of momentum so far, now this could easily just continue through here, and there's no bearish divergence, everything's gravy, it just rips to the upside. But if this gets rejected right here and starts to roll over and we get 1 or 2 days, or weeks rather, of, red histograms, this is going to look like bearish divergence double top at resistance, which is our, slope line on the TJD TDMACD. And we see that a lot of time. And then I'm not sure if we have we see a pretty strong, kind of support level holding here. A couple touches there. We kind of front run it right there. And then we see it again there. Arguably we could draw it a little differently. Maybe it's supposed to be something like that. And we kind of overshot it. Could go either way, but we basically have reclaimed a key level, got a technical breakout. Man, I'm hesitant on these uranium stocks. I'm very bullish on them long term. Very, very bullish on them long term, but I don't know. I think if we see, we're probably going to see some of the air come out of commodities if we see the stock market and cryptos looking good and seeing continuation and volume coming in. That's my honest opinion. There's only so much money. It's got to go somewhere. So where does it come from? Does it come from the bond market and run into risk-on assets? Does it come from, commodities and then run into stocks and cryptos? Does it come out of gold? Does it come out of cash? Probably all those things. If we see continuation. Copper, same thing. Looking like a double or triple top here. This is the CPER index. Not the miners, more the actual commodity itself. Looks, man. It's like the same chart when we look at the weekly here. We see the knife is like at extremely high levels. Typically we'll see divergence and then a top after we see something like that happen. Again, very bullish long term. We put in a higher high, and then the monthly potentially looks like it could be topping out here. Man, I'm real skeptical about these commodities right now, which, maybe it makes me a little more bullish about risk on. Platinum doesn't look good. Below the 200 exponential and simple. Definitely like underperforming. Palladium looks a little better, but getting a pretty hard rejection right here off the 200 exponential and simple. I was trying to avoid this cross, and it basically is looking like a pretty hard rejection. Now we got a rejection here and then saw a continuation. We got a rejection here, saw a continuation, and then it rolled over. So even if we get a rejection on the daily right here, maybe next week it pushes back up one more time, gets a close at resistance, and then rolls over. I really want to see, it consolidate between 2272 and 2570, reload the indicator oscillators, and then move to the upside. But we've had this blue slope line since October of 2021. We had a little red in here, but now we have finally broken down below it for like the first legitimate time to where, we broke down below it here, but it didn't ever cross red. And then when it finally did, that was when we got the push up and we had that crazy manipulation candle or whatever, capitulation slash, this is like the most ridiculous candle I've ever seen in my life on like something real. When I say something real, I mean a paper contract for something real. But if this flips over red right here, it's going to look really bad and probably fail. And probably go much lower. Yeah, the commodity charts look a little sketch right now, honestly. All right, I think we got them all. We got some targets. We got a couple trade setups. We're going to pay attention to the weekend for some possibly actual bullishness from cryptos. I think if we have a strong close, going into the weekend, the probability of a strong weekend looks much better. Now, granted, it hasn't for a while done anything over the weekend, so maybe this is going to be the one. We will have to wait and see, obviously, but definitely starting to look decent, reclaiming some key levels. CW says, thank you, broski. Lazy boy. Oh, I think these are old. Haha. Okay, yeah. So, yeah, I think that's going to do it for today. Sorry for the delay today, guys. A little unexpectedness, but, sometimes life happens. But that should do it. So, what do we go? About 2 hours. Hour 46. Pretty good. Peter Gerd says, really interesting point with commodities maybe being weak. Yeah, I mean, at least short term. Maybe not going to all of a sudden just nobody wants commodities anymore. I think people still want real stuff. I think the macro hasn't shifted, but we definitely could see a relief rally, or consolidation. Like commodities could sell off, risk on could be back on. It could last for a couple weeks. It could last for a month. We could have a nice push back up. Everything looks gravy again. Everybody gets comfortable, and then all of a sudden right back to the trend. Big D says, are we done? Can I go prepare the drinks for the weekend? Yeah, man, it's game on now. It's weekend time, Big D. That's it. Wrapping up here. So we went about an hour 47. I like to keep it right around 2 hours. So, yeah, everybody have a great weekend. Happy St. Patrick's Day. Hopefully we see some strength in crypto. Make some nice little gains over the weekend here. That would be nice. It would be nice technically to see some of these levels, starting to look a little more bullish again. So we'll see how these next couple hours go. We'll see how the closes look on stocks. If we close strong on stocks, I think Monday we have a nice strong day on Monday too. Typically we see continuation in the direction of our Friday close. Cryptos, again, I'd love to see some strength over the weekend. We definitely have some potential to start technically making these charts look good. But I think the most important thing is we are still range bound on crypto between like that 45K and whatever it was, 37.5, I think it was. Level on the monthly. So that's the most important thing to pay attention to. But in the meantime, we could easily have bounces from the bottom of the range to the top, from the top to the bottom, and just keep oscillating. And that is what I expect to happen. So that is it for our Friday afternoon / morning stream. It is 2:51 p.m. on March 18th, 2022. Appreciate each and every one of you. Thank you all for tuning in. To all the group members, thank you all for your support. And, take care of your family. Enjoy your weekend. Stay out of trouble. Don't drink and drive, all that good stuff. Remember, more importantly than anything, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research. Trade responsibly. Have a great weekend. Appreciate all you guys. But that is it for today's stream. Crypto Trend Trader. And I'm out.